On January 29, 2026, the global financial system didn't just blink, it stared into the abyss of a mathematical impossibility. For a few chaotic hours, the price of silver did what every algorithm, central banker, and commercial hedging desk said it never would. It shattered a 40-year suppression ceiling to hit $121.64 an ounce. To put that number in perspective, it wasn't just a new all-time high, it was an economic siren screaming that the dollar had lost control of the physical world. In the trading pits of Shanghai, the decorum of the exchange evaporated. Buyers were paying premiums of $6 to $9 over the spot price, effectively decoupling the physical metal from the digital price screens. In New York, the panic was quieter, but far more dangerous. The vaults were effectively empty. The system was moments away from a force majeure, a total default where the exchange admits it has no metal to deliver. But then, the lights went out. In exactly 31 days, the price didn't just correct, it was executed. It crashed from the dizzying heights of $121 back to a subdued $81. The mainstream financial media, desperate for a simple narrative, pinned the blame on a political headline, the nomination of a hawkish Federal Reserve Chair. But the math tells a darker, more precise story. This wasn't a market crash, it was a controlled demolition. Today, we open the black box to show you exactly how 3 regulatory changes, hidden in plain sight and deployed with military precision, wiped out billions of dollars in retail wealth and saved the bullion banks from the greatest short squeeze in human history. To understand why $121 wasn't a bubble, but a return to reality, you have to understand the fundamental setup of late 2025. The world was running out of silver, and it wasn't because of hoarding or jewelry, it was because silver had become the industrial oxygen of the 21st century. By 2025, the green energy transition had devoured the world's stockpiles. Solar panels, which require paste made from pure silver to conduct electricity, were being installed at record rates. Electric vehicle batteries, 5G towers, and the solid-state chips powering the AI revolution, they all demanded silver. The geology, however, refused to cooperate. Silver mines are notoriously difficult to scale. You cannot simply turn a dial and produce more metal. In 2025, the world's industries consumed a staggering 1.1 billion ounces of silver. The global mining sector, strained by decades of underinvestment and declining ore grades, could only produce 820 million ounces. That created a massive structural deficit of 295 million ounces in a single year. To visualize that gap, it is larger than the entire production of the top 3 silver-producing countries combined. For years, the market filled this gap by draining above-ground stockpiles, but by late 2025, the cupboards were bare. Then, on January 1, 2026, the geopolitical trap snapped shut. The People's Republic of China, the factory of the world, and a major processor of silver, implemented a strict export licensing system. Citing national security and the strategic importance of green energy materials, Beijing effectively locked 120 million ounces of annual supply inside its borders. This wasn't a trade tariff, it was a resource blockade. Overnight, the West lost access to a supply source roughly equal to the entire registered inventory of the COMEX. The global supply chain snapped. The powder keg was packed, the fuse was lit, and the market was waiting for the explosion. While the physical market was screaming shortage with flashing red lights, the paper market, where bankers trade futures contracts, was living in a dangerous fantasy land. By mid-January 2026, the paper-to-physical ratio on the COMEX had exploded to a staggering 356 to 1. This is the smoking gun of the crisis. It means for every single ounce of real, touchable silver sitting in a registered vault, there were 356 paper contracts claiming ownership of it. It was a game of musical chairs played on a global scale, but instead of one chair missing, there was only one chair for every 356 players. This imbalance created a catastrophic risk for the Big Four bullion banks. These institutions act as the market makers, selling futures contracts to provide liquidity. But in 2026, they had accumulated a short position exposure of over $200 billion in notional value via OTC derivatives. As long as silver stayed cheap, these bets were profitable. But as silver crossed $50, then $80, then $100, the banks faced unlimited liability. If silver kept rising past $120, the margin calls on these banks would have exceeded their liquid capital reserves. They wouldn't just lose their quarterly bonuses, they would face insolvency, threatening to drag the entire clearinghouse system down with them. They needed a way out, and they needed it fast. In January 29th, Washington, D.C. inadvertently gave them the perfect cover story. President Trump announced the nomination of Kevin Warsh for Fed Chair. Warsh, known for his criticism of easy money and his support for a strong dollar, was the perfect boogeyman for gold and silver investors. The markets panicked, fearing that Warsh would hike interest rates to crush inflation, which theoretically hurts non-yielding assets like silver. The price wobbled. That wobble was the signal the CME Group was waiting for. The exchange didn't just let the market sell off naturally. That would have been too risky. Dip buyers might have stepped in. To ensure the price broke, the exchange deployed a weapon that no retail trader or hedge fund could fight against: the margin hike. Margin is the collateral you must post to hold a position. By raising it, the exchange forces you to come up with millions of dollars in cash instantly, or your position is sold at market price. It happened in 3 calculated strikes, a 1-2-3 punch designed to break the psychology of the bulls. Strike 1, early January. As the rally began, the CME raised margins by 30%. The market absorbed it, driven by the insatiable physical demand. Strike 2, January 28th. As silver kissed $120 and the banks panicked, the CME raised margins by another 22%. Suddenly, the cost to hold a contract jumped. Thousands of smaller speculators, already leveraged to the hilt, were forced to sell. Strike 3, January 31st, the knockout blow. With the price already reeling from the Warsh news, the CME delivered a final crushing 36% hike. In just 31 days, the capital required to hold a silver position had increased by 67%. It was a margin call massacre. It didn't matter if you believed silver was going to $50. If you didn't have the cash to cover the new margin, your computer liquidated you. This created a self-feeding loop. Forced selling drove the price down, which triggered more stop losses, which drove the price down further. The price collapsed 33% in days, falling to $81. The threat to the banks was neutralized. The paper market was fixed. The crisis was averted. Or was it? The autopsy of the crash reveals that this was merely an illusion of solvency. While the paper price tanked to $81, the physical metal kept vanishing, ignoring the futures market entirely. During the crash, when people were supposedly selling silver, the COMEX registered inventory didn't go up, it dropped. It fell from 121 million ounces to 119 million ounces. Buyers were using the price drop to strip the vaults bare. Even more telling were the lease rates. In a normal market, the cost to borrow silver is near zero. During the crash, lease rates spiked to 200% annualized. You don't pay 200% interest to borrow something that is plentiful. You pay it when you are desperate to locate physical bars to settle a trade failure. The market remained in backwardation, a rare anomaly where the cash price is higher than the futures price. This is the market's way of saying, I don't care about your paper promise for next month, I need metal now. The disconnect was visible globally. While the COMEX price flashed $81, dealers in Dubai, Singapore, and Shanghai continued to transact at significant premiums. The Shanghai premium remained stuck at nearly $10, proving that the paper crash had failed to fool the physical buyers in the East. They knew what the West was trying to deny. The silver is gone. The silver squeeze of 2026 taught us a brutal lesson about the difference between price and value. In a paper market, the house always wins because the house can change the rules. They can hike margins, change leverage limits, and alter the definition of delivery, but they cannot print metal. They cannot algorithmically generate a silver mine. The math remains the ultimate judge, with only 100